If you're frustrated with earning just 3% on CDs while banks profit, it's time to explore smarter alternatives. Today, we're breaking down 5 investment options that could boost your returns without taking on unnecessary risk. Let's dive in with Leibel on Fire.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hello again, everyone, and welcome to this episode of Leibel on Fire. I'm Freddie Bell, and joining me is the author of 2 different books. One, Living with Financial Anxiety, and also the book entitled Authenticity. We're talking about none other than Leibel Sternbach. Hello, Leibel, and welcome back.
Hey, how are we doing today?
Unbelievable, and I'm so glad to be with you because we're talking about frustration. And in fact, the title of the show today is Frustrated with 3% CDs. We've got some alternatives for you, and as I understand it, you have 5. So let's get into it if you don't mind. We mentioned in the intro that banks continue to offer low CD rates. That's a fact, despite the volatility that we're seeing in the economy today. So what I'm wondering, Leibel, is how do they profit from this, and what should the retirees know about the bigger picture?
Yeah. So the important thing to understand about banks is that they're in the for-profit business, right? They're not nonprofits that are holding your money. They're very actively profiting on it. And the value proposition that they kind of generally say is we're going to help you. We're going to help share with you some of the wealth that we generate. We'll loan out your money and we'll pay you some of that interest in terms of savings. Of course, the banks, because they're now all publicly traded and they're owned by their shareholders, they have this drive to increase their earnings and increase their profits. And so what ends up happening is, and we saw this just happen, right? The interest rate, when interest rates came up, the banks were the slowest to increase their rates. And then as soon as the Fed started dropping rates, they plummeted like a rock. They just started sinking. And Bank of America is back to basically paying 0 on their savings accounts. They don't even offer CDs that have like more than 1%. It's kind of ridiculous. They're literally taking the whole profit to the max thing to a whole new level. When it comes to investors, we are not limited to the banks, right? One, you can shop around on different banks and you can play that game of getting higher interest at other banks and the online banks that don't have physical branches. But there is some risk to that because some of these online banks, you don't really know what they're doing. And there was a recent bank that just failed because they were connected with a crypto bank. And so the crypto bank wasn't doing their accounting properly. And so even though all the assets are somewhere there, nobody really knows where their money is, right? Because this online bank wasn't doing their accounting properly.
That's a problem.
Yeah, so it's a problem. When it comes to where do we find these rates, right? Where do we find returns? We got to look for other places and basically cut the bank out of the middle, right? There are lots of other ways to get interest. We don't need the bank to be in the middle between us and the interest rates.
We don't need the banks to be in the middle. We're talking about 3% CD rates and alternatives. So how do money market funds and ETFs compare, Leibel, to CDs in terms of safety, in terms of what returns and liquidity? Can they be a smarter alternative for retirees today?
So I would think so. Again, risk reward, right? Everything is different. They're not exactly the same, but let's talk about what a money market fund is and then a money market like ETF. Okay. So a money market fund is a very specific type of mutual fund where they guarantee the dollar. They guarantee you put $1 in, you're going to get $1 back, and then you're going to earn interest on that. The interest that you earn is usually tied to the 1 to 3 month treasuries. So short-term treasuries, they take a management fee, usually 0.5% to 1% for being in that mutual fund. Schwab has them, Fidelity has them, Vanguard, everybody's got one, but they take, I think the category average is 0.4, 0.5% as a management fee. Some are more, some are less. The problem is while you get the $1, you kind of have your principal almost guaranteed, not 100% guaranteed to come back. The interest rate that you're getting will change based on the Fed, right? So the Fed reduces rates, that will come down. The other thing is they only pay interest once a month. So you kind of got to hold them until the interest gets paid in order to get the interest. And in that way, they're kind of similar to CDs. Now, some of them will allow accruing daily and they'll pay you out even if you sell. Some don't. I personally prefer going into money market like ETFs. So Vanguard got one, iShares has one, there's a bunch of them out there. And what these ETFs do, they invest in the same 1 to 3 month treasuries, except it's in an ETF format. So you can buy and sell it during the day. And because it's an ETF, everyone sees exactly what it's holding. The interest gets paid into the ETF, which increases the ETF's value. So that means every single day, the ETF goes up in value. And so if you want to sell it, you buy it on Wednesday and you want to sell it on Thursday, you get 1 day worth of interest and you get it when you sell because it's baked into the price of the ETF. And then usually once a week, sometimes once a month, they'll pay out their interest and you'll get that as cash in your account. And the value of the ETF goes down. So that is the next category that I really like. And if you want help getting into one of those, just call us up. We do that for free, right? We will open up a brokerage account for you and put your money into one of these low cost money market like ETFs, and we'll put you in there. And that is free. That is our pleasure to do just to give you access to those returns because there's no reason why the banks should be profiting off of you when this is available. And Vanguard's got one where it's like 0.07% their management fee. There is a loss lead, but essentially you're getting the full federal fund rate on your money, which is awesome.
So we can access you by going to yieldsforyou.com?
Yep. Go to yieldsforyou.com, book an appointment, just put in the notes, I'd like to open up a money market investment account, and we will get that taken care of for you. Again, 100% free, our pleasure. We want to help give people access to as much return on their money as possible. It really pisses me off that the banks are profiting for no reason.
We're talking about interest rates, and I'm just curious. You've said before, Leibel, that a lot of retirees get tempted by investments offering high returns. But what are some of the hidden risks that retirees need to be aware of before chasing that particular yield?
When it comes to yield, right? So you'll see, and I'm sure you're getting bombarded by these advertisements. You'll see things, you'll see like senior floating rates. You'll see there's accredited investors only 8 to 12%. You'll see people marketing annuities and they'll be like, you can get 8% in returns with 0% floor. So the market goes down, you don't go down. There is always a catch with all of these. The question is, do you know what the catch is? Are you okay with the catch? And are they disclosing to you fully what the catch is? And oftentimes the person who's selling it doesn't fully understand the catch. So they don't understand it. So they don't communicate it because it doesn't mean anything to them. And so therefore it's like gibberish. You hear static on the radio. Like there are words being said. I guarantee you there's a radio station on the other side of that. And there's a very nice show going on. But you don't, because you're not hearing the words, it doesn't mean anything to you. It just becomes static. And so oftentimes that is kind of what happens with a lot of these risks. They don't understand the risk, so they just don't talk about it, or they explain it in a way that oversimplifies them. So when we talk about returns, right, and we talk about, okay, well, you can get return on your money, what you really want to do, right, and it depends on whether this is short-term money or it's long-term money. Oftentimes, we're putting money into bank CDs because this is our short-term money. We don't want to risk our principal, or if we risk our principal, we don't want to risk more than 1 or 2% because that will have a change in our lifestyle, right? Or it'll have a change in our ability to sleep at night. And so when we look at where we can park money, yeah, there are ETFs out there that pay 8 or 12% returns. But guess what? Market crashes, they're going down with the market. And so what you got to look at is everything that goes up has that same ability to go down. And you want something that goes up more than it goes down. And when it goes up more proportional than it goes down. And that up and down that it goes is something that you're okay with, right? Because there's always a risk associated there. And if there's no risk of the up and down, then maybe it's a time risk, right? Maybe you have to lock in your money for a certain period of time, or maybe it's when you take that money out, there's a surrender charge, or there's a spread on what you can sell it for, right? You might not be able to sell it for what you bought it for, or more than what you bought it for, in which case you take a haircut on the sale.
Wow. Talk to us a little bit about market yield guaranteed annuities. I see that I'm hearing more and more about that as a popular alternative to CDs, but I'm not certain how they work. I'm wondering if our retirees are having that same question, and what should be considered before investing in them in the first place, Leibel?
Yep. So multi-year guaranteed annuities, and there's a whole bunch of annuities that come under this category. But essentially what these are, the insurance companies' competition to bank CDs. And it's actually in markets like this where they tend to shine, because the insurance company makes a play and they say, we're going to lock up your money for 3, 5, 10 years. In return, we're going to give you a fixed rate of return, right? And they always pay more than the banks, because they're trying to take money from the banks. And so they understand that you've got your money parked in a CD, and they're like, we're going to give you the same prospect. You give us your money for 5 years. We're going to give you, I think I saw a rate the other day was 5.25. We're going to give you 5.25 for 5 years, which is a pretty good deal. And in return, all we ask is if you surrender early, you're going to pay a surrender penalty. Right. Now, banks with bank CDs, you generally forfeit your interest if you surrender it early. There may be even a surrender penalty. So in a lot of ways, it's comparable. What is not comparable is that the surrender charge with multi-year guaranteed annuities is usually a lot stiffer than with a bank CD. All right. So you are giving up that. You're going to be paying income tax on the growth unless you roll it over to another multi-year guaranteed annuity. But in short, it's a viable alternative to bank CDs, and it is something that is definitely worth exploring, along with this whole category of market-linked CDs and structured notes, which is basically our bread and butter at Yields for You, is these type of bank CD alternative products. We very much are a strong believer that every retiree should have some form of them in your portfolio, not necessarily annuities, but the products that have downside protection, upside participation, or a fixed rate of return, because that allows you to kind of weather these market turbulence without worrying.
So what about the YFYAs? Can you explain that? Is that a part of that same family?
So that's actually our ETF that we launched. It's the Yields for You Strategy A ETF, which is an ETF that we designed for that spending money, right? So I'm portfolio manager for that ETF. It is in our client accounts. We use that for that spending bucket. That is that. It's kind of like a money market alternative. We take on the least amount of risk to get the greatest amount of return. We're looking to get that consistent 5 to 6% return after fees, right? Consistently. So as interest rates come down, we dial up the risk to take on a little bit more risk and get more yield. So think of it as an actively managed, extremely conservative ETF that is designed to consistently get you as much of the free interest as you can get, right? So whether it's treasuries or it's low risk corporates or things like that.
So that's a great point to mention, yieldsforyou.com.
Yeah, yieldsforyou.com. Go to our website or go to your favorite brokerage account and go check us out.
So finally, Leibel, with inflation eating into savings, is sticking with a low yield CD a dangerous strategy, or how can retirees simply ensure that their money keeps up with rising costs?
CDs, generally speaking, are designed to keep pace with inflation. They're not going to beat inflation. If they beat inflation, it's by a tiny amount. So just keep that in mind. Like, I think historically, there's very few periods where CDs actually outperformed inflation, right? It's you maybe get 1% above inflation. So if you want to keep your buying power, yeah, go give it to the banks. The banks are going to profit off of it, but you'll maintain your buying power. If you want to get more than your buying power, if you want to earn some interest, if you want to earn some spending money off of that, then you need to search out elsewhere and get greater returns. And you're just understand, you're leaving money on the table. As soon as you hand money to the bank, you are saying goodbye to money that is rightfully yours, right? You can go hand it to the federal government and they will give you more money than the bank will give it to you, right? There's no reason why you should be paying an intermediary to just give you a haircut, right? Like, it doesn't make sense.
You don't have to settle for low CD rates while inflation eats away at your savings. You don't have to do that. There are safer, smarter alternatives that can help to make your money work harder for you. So take control of your financial future. And until next time, this is Leibel on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.